Hello class, we are going to go through a few practice problems for chapter 11, so I hope this is helpful to you. This is coming to you from page 447 in the textbook. We're going to take a look at problem 7 or P7 in regards to notes payable and wages payable. So it tells us in part A, Candlelight Corporation, whose fiscal year ended June 30, 2014, completed the following transactions. So the transactions are from May 21st, June 30, and July 20. And what we want to do is we want to record those entries for the notes payable transactions. So May 21st says that we obtained a 60-day extension on a $36,000 trade account payable owed to a supplier by signing a 60-day $36,000 note. The interest is in addition to the face value at the rate of 14%. All right, so let's go on ahead and work this problem out. So what we want to do here, um, we are going to show, let me go back, make sure I got that right. We're going to show that we obtain a 60-day extension on a $36,000 trade account. So what that means is that we normally had an accounts payable, but we need extra time to pay accounts payable, and so it turns into a notes payable. Now we have an official note. Why do we know this? Because they're charging us interest at 14%. So we don't have to do any calculations just yet. All we have to do is record that the accounts payable is changing over to a notes payable. So this is what the journal entry would look like. We will put May 21st, and then it would be accounts payable and notes payable. So accounts payable is decreasing and notes payable is increasing. Thus the debit to accounts payable and the credit to notes payable. And the amount is for the $36,000. All right, so that's what that journal entry would look like. So the next one says on June 30, made an end of the year adjustment entry to accrue interest expense. Round to the nearest cent. So here it's the end of the year, and what we needed to do is record the interest that accrued for the 2014 year on that particular note. And so we need to do a bit of calculations and then record this to our journal. So let's do the calculations over here to the side. We know that the note was for $36,000. We also know that it had a 14% interest rate. And we also know this was for 40 extra days over 365. So what you want to do is you want to multiply out the 36,000 and the 14% and the 40 days first, and then divide by 365. Your answer would end up being $552.23. And why did I make that a decimal? Sorry. There we go. All right. So that's what we're going to use as the amount for our journal entry. So our journal entry will be June 30. The interest expense will always be debited because it's an expense account. And interest payable, because we're not paying it right now, but we have to show that it has accrued. This is the interest for 2014. We're not paying it yet, but we have to show that this is the amount of interest that we are responsible for. And I'm sorry, I said 23, it should be 33. The interest that we're responsible for in 2014. All right. The last journal entry takes place in the next month, June 20, and this is when the actual amount is due, the $36,000 plus the 14% interest. So it says we paid out the note plus the interest due to the supplier. So let's go on ahead and let's do some calculations to the side. So we know that again, the note was worth $36,000. We know that there was a 14% interest rate. And the days that we're talking about here is 20 days out of 365 days. Again, you want to multiply out all the numerators, 36,000 times 14% times 20 days, and then you divide by 365 days, and that should give you $276.16. So that's the amount of the interest that is paid in the current fiscal year. Remember, this is going on a fiscal year, not a calendar year. So that's why I went from June to July. It doesn't mean actually the next year, but the next fiscal year, when their fiscal year starts. So we say July 20, and we say notes payable, which reflects the amount that we owe, the $36,000. Then we put in the interest expense for the current fiscal year, which we just calculated at $276.16. Then the interest payable that we calculated earlier is now also being atoned for, paid for, $552.33, and the cash is going out. So we credit it for the total amount of the note and the interest. 36 828.49. There we go. All right. Let's continue looking here. And it says, I'm going to skip over to, I think you guys can figure that out. We then go into part B, and part B gives us information about the payroll. And what we want to do is we want to record the payroll entries to record number one, the monthly payroll and the employer payroll. The monthly payroll and the employer payroll. So if you read the book, you know that there are only certain taxes that the employees are responsible for and certain taxes that the employer is responsible for. Both the employee and the employer are responsible for Medicare and Social Security. However, only employers are responsible for federal unemployment tax and state unemployment tax, whereas the employees are responsible for federal income tax and state income tax and any medical insurance premiums that they're responsible for. So, with that being said, they do give us a series of values representing the balances for each of these accounts, and we need to record them in a journal. So the first one we're going to address is the monthly payroll. The monthly payroll journal entry represents, represents, ah, it's not erasing. Sorry about that. It represents the, I'm trying to do 5 things at one time here. Okay, so the first entry represents the withholdings that come out of the employee's check collectively, so all of their employees, the withholdings like income tax, state income tax, Social Security, Medicare, any insurance that the employee is responsible for, and then we show them the we show the amount of the net income. So we're going to have wages expense is always going to reflect gross income, and then the wages payable is always going to reflect the net income. So when we're talking about gross income, that's when you look at your paycheck and you see that nice big amount at the top. And you're like, wow, I wish I was taking that all home with me. But then after they take out all those other deductions or withholdings, then you are left with your net income. That's what you take home, your net. And so that's what is represented here by the wages payable. So let's record this entry here, July 31st. So wages expense, and you can always follow along this and look in the book. I'm just showing you how it should be done. I'm not going to go through every single thing. Is going to be debited, of course, because it's an expense. And then we're going to put in the employees, and I'm going to abbreviate there here, the FIT, federal income taxes payable. I always need to put payable because it is a liability and has not been paid yet. So $71,163. Then we have the employees SIT or state income tax payable, and that's 11,727. Then we have the Social Security tax payable, and that's 17,253. Then we have Medicare tax payable, and that's $4,035. Then they told us about the medical insurance premium payable. So that's what they take out of all of their employees' checks for their uh, contribution to the healthcare plan. And then we have wages payable, and the wages payable reflects the wages expense minus all of these withholdings. And so that comes up to be 164,472. So that records the payroll. The next journal entry records the payroll expenses. This is the expense to the company for hiring employees. And this is their responsibility towards the various agency. Their responsibility, Social Security, Medicare, their responsibility for the insurance, their responsibility for unemployment taxes. So here we go. We have payroll, taxes, and benefits expense. And that's 70,034.64. And then we have a series of credits. So we have their contribution to Social Security tax payable, which matches the employee's contribution, 17,253. Then we have their contribution to Medicare tax payable, which is the same amount. It matches what the employees pay. Then we have their contribution to the medical insurance premium payable. And of course, that's going to be considerably larger than what the employee's paying because usually the employer pays 80% of that. Usually, not all the time, but usually. All right. Then we have the federal unemployment tax FUTA payable, and that comes out to be 1373.76. And then the SUTA, which is the state unemployment tax payable, and that's 9,272.88. So we can see how all of these expenses ended up coming up to 70,334, and that's the employer's amount there. And I should add in the calculations. Where do my calculations come from? So, well, actually, we may not need it. For the 38,400, that was, we had to take the 96,000, I'm sorry, 9,600, and divide that by the 20%, and that gave us 48,000. Then we take that 48,000 and we subtract out the 9,600. That gave us 38,400. And then in order to come up with the federal unemployment, we take the 0.8%, and that's times the 171,072, and that gives you 1373.76. And then the 5.4% for the state, and that's again times the 171,720, and that gave us 9,272.88. All right. The last problem, practice problem that I want to take a look at comes from the product warranty area. And so it tells us that a company is engaged in the real sale of high definition televisions, blah, blah, blah. I'm not going to read through all of that. So, what they want us to do is to prepare journal entries to record each of the following: A, the warranty work completed during the month, and then B, the estimated liability. So, let's go on over here and erase what I have here. Excuse the background noise, got a lot of stuff going on here. All right. So for January 31, we want to show that we received a cash of 18,884. And just to clarify, that's coming from the sale right here. 18,884 was collected as service revenue for the labor involved. All right. So the estimated product warranty liability, long name, is $17,530. And again, that came from, whoops, the information, the problem given right here. All right. So then we have to factor in that service fees revenue that we earned, and that's the 18,884. And then merchandise inventory reflects the 17,530 that we use to record repairs and related revenue. So this is what we call, remember we call this a compound entry, where we show, actually we would probably break this out to where we would see it as cash and then service fee revenue. That's really how it should have been. Why it was like why they put it together as one. So it'll just show you in two different ways. Each way is right. And then we would have done the estimated product warranty liability, and then the merchandise inventory to show the inventory that was used for the repairs and the cost of that. All right. All right, so then we also have to show, let me erase this, my screen is not that big. Then we also have to show on January that we had the product warranty expense and the estimated product warranty liability 10,800, 10,800. And this is to record the estimated warranty expense for January. And this is based on the TVs sold times um, the percent of repairs, of expected repairs, times cost of parts. So we sold 450 TVs. The percentage is about 20%. That's what they told us. And the cost of the repairs is $120. So that's where we got the 10,800 from. All right. Oops. So if we go here, it says calculate the balance of the estimated warranty liability account at the end of the month. And so what we have to do here is remember it said we determine our beginning balance of the account, which was at 28,600. And I believe they told us that in here. There it goes. It had a credit balance of 28,600. So that's a positive balance. And then we have to subtract out the cost of warranty parts used, and that was $17,530. Then we want to add in the estimated liability for TVs sold, and that was the number we just calculated, was 10,800. So then the ending balance ends up being $21,870. All right, I hope this was helpful to you.